So there is an artificial intelligence hardware company operating right now, like in 2026, valued at over $2.4 billion.
Right.
But if you look at their first quarter operating revenue, they brought in $53,000,
Yep.
which is, I mean, that is quite literally less money than your neighborhood Pizza Hut makes in a quarter.
Yeah, it's wild. It completely breaks the traditional rules of corporate finance.
Exactly.
We're basically witnessing this fundamental decoupling of immediate commercial performance and, market valuation. These companies are pulling forward billions of dollars in future expectations just to stockpile cash today.
Because in this modern AI boom, a company's most valuable product isn't, it's not their microchips or their software or their server racks.
Right.
Their most valuable product is their own stock. And they're selling it directly to the market to survive and scale before they ever make a dime of profit. So welcome to today's Deep Dive.
Thanks to be here.
Our mission for this session, for you listening, is to explore the fascinating and honestly, sometimes controversial ways modern tech companies are funding this massive AI revolution.
It's a huge topic.
It really is. And we have an incredibly dynamic stack of sources to go through today. We're anchoring this with a foundational 2019 academic paper from the Journal of Financial and Quantitative Analysis, which details the rise of alternative equity issuances.
Yes.
Then we're pairing that academic theory with real-time 2026 financial data, analyst reports, and some pretty heated retail investor debates centering around two specific companies.
IREN and Poet Technologies.
Exactly.
Yeah.
IREN, which is a Bitcoin miner pivoting hard into AI, and Poet Technologies, an AI photonics company.
The contrast between the rigid academic theory from 2019 and the absolute chaos of the 2026 public markets is what makes this stack so compelling.
Totally.
Because we're looking at the actual mechanics of how the public stock market is essentially functioning as a crowdsourced venture capital round.
Okay, let's unpack this. Because before we look at IREN or Poet hoarding billions of dollars, we really need to understand the structural mechanics.
Right, the how.
Yeah. How are they legally bypassing the traditional Wall Street gatekeepers to raise this kind of money so quickly? I mean, historically, a massive public fundraising round required an investment bank, a huge roadshow, a ton of scrutiny.
Right. So that traditional route is known as a seasoned equity offering, or an SEO.
Okay.
And in an SEO, an investment bank underwrites the offering, essentially putting their own reputation on the line to certify the company's value to the market. But the 2019 study by Billett, Flores, and Garfinkel highlights a really critical regulatory shift.
Which was when, exactly?
Between 2005 and 2008, the SEC changed the rules to streamline alternative methods, paving the way for the explosion of something called an at-the-market offering, or an ATM.
An ATM. And the mechanics of an ATM completely flip the script, right? Like, if a traditional underwritten SEO is like taking a highly publicized fire hose and aggressively filling up your corporate swimming pool all at once,
Great analogy.
then an ATM is more like a strategic, quietly dripping faucet that you only turn on when it rains.
Yeah, the study actually refers to it as the dribble out method, which captures that mechanic perfectly.
Dribble out. I like that.
Yeah, instead of a single massive transaction, the company hires a broker to issue small, variable quantities of newly minted shares directly into the secondary market.
So they aren't dumping them all at once.
Exactly. They rely on algorithmic trading to monitor the daily volume-weighted average price, just selling shares into the existing trading volume over months or even years without causing a massive price shock.
They just turn the faucet on when the stock price spikes and turn it off when the price drops. The paper notes they follow a strict mechanical rule based on market momentum. But let me push back on this for a second. Because the traditional view is that if a major investment bank isn't putting its stamp of approval on a firm, shouldn't the market assume that firm is inherently riskier or, of lower quality?
Well, what's fascinating here is that the academic theory from Shimonor and Fulgari, which is cited in the paper, takes a very different angle.
Okay.
They argue that firms with highly opaque, unobservable quality, meaning their true potential is completely invisible to the average analyst, those are the ones that actually want a bank certification to prove they're legitimate.
Oh, interesting.
But the data shows ATM firms fit a completely different profile. They tend to be smaller, they already carry more cash, and their R&D expenses are just through the roof.
Which means if you have a massive, speculative, technological, leap-like next-generation AI hardware, The cost of getting a traditional underwriter to thoroughly diligence and certify the futuristic tech is just too high.
Exactly. The banks might actually underprice you because they don't understand the upside. So skipping the bank makes strategic sense. And the data strongly supports that. Like, the most telling finding from the 2019 study is the cash retention rate.
Right.
Firms executing traditional SEOs stockpile about 84 cents of every dollar they raise. They hold on to it. But ATM firms only stockpile 65 cents of every dollar.
Meaning they are burning through that capital significantly faster.
Yeah, they're using the ATM as a continuous, flexible utility line. They use it to fund immediate, capital-intensive R&D while maintaining a massive buffer of financial slack. They're directly converting daily trading volatility into runway.
Which is incredible. And IREN shows us exactly how companies are using these flexible cash war chests right now.
Oh, absolutely.
For you listening, this company, formerly Iris Energy, was purely a Bitcoin miner.
Yeah.
Now they are executing a massive pivot to become an AI neocloud infrastructure provider, and they are raising capital on a scale that is almost difficult to comprehend.
It really is.
According to our 2026 data, IREN has raised $9.2 billion this fiscal year alone. And as of January, they have $2.8 billion in cash just sitting on the balance sheet.
The sheer velocity of that capital accumulation is staggering, and they are layering different financial instruments to achieve it.
Let's look at their latest maneuver, because it is a masterclass in market mechanics.
Yeah, the convertible note.
Right. They issued a $3 billion convertible senior note, plus a fully exercised $400 million green shoe option. So $3.4 billion total, maturing in 2033.
Huge numbers.
But what's really clever here is the capped call transaction. They took roughly $200 million of the cash they just raised and bought an insurance policy against their own equity dilution.
Right. They effectively purchased call options to warehouse the upside risk, capping the conversion premium at 100%.
So if the notes convert, current shareholders are protected from massive dilution all the way up to a stock price of $110.30.
Which is double their May 11th closing price of $55.15.
Exactly.
It demonstrates a highly sophisticated approach to capital structure. They're taking on debt that has the potential to convert into equity, but they're spending a premium to ensure that if their AI infrastructure play works and the stock skyrockets, the existing shareholders aren't punished for the early borrowing.
But, I mean, a $3.4 billion raise isn't just for operational overhead. The only thing eating capital at that scale right now is physical infrastructure.
Yeah, chips.
They are buying 140,000 GPUs. They're backing a $3.4 billion cloud agreement with NVIDIA and a $9.7 billion contract with Microsoft.
Massive deals.
But it makes you wonder, though. Put yourself in their shoes, shifting from mining crypto to buying 140,000 GPUs. Is this just a company chasing the latest tech trend with a giant war chest? Or is this a legitimate infrastructure play?
Well, Danielfin's AI stock analysis currently rates IREN 6, which is a hold, despite their massive 40% year-to-date growth.
So the market seems slightly hesitant about the pivot.
The hesitation comes from the execution risk, but functionally, this is exactly what the academic models predicted for capital-intensive transitions.
So
AI data centers require unprecedented amounts of power and cooling. IREN's previous life as a crypto miner gave them the hardest asset to acquire in 2026, which is massive permitted energy capacity.
Oh, that makes sense.
They are utilizing the public markets to front-load the staggering cost of filling those data centers with NVIDIA chips. They are physically building the bridge between raw electrical grid capacity and AI cloud computing demands.
Okay, so IREN shows us how companies use these mechanics to buy physical hardware off the shelf.
Right.
But our second company, POIC Technologies, is playing an entirely different game. They aren't buying infrastructure, they're using retail capital to fund foundational technology that barely even exists commercially yet.
Right, moving from infrastructure to the literal hardware of AI. POIT operates at the deepest physical layer of the AI boom, which is photonics. They design photonic integrated circuits, or PICs. To understand why this is a multi-billion-dollar problem, we have to look at the physical limitations of current AI clusters. Right now, GPUs talk to each other using copper interconnects.
And copper has basically hit a physical wall.
Exactly.
When you try to push data 800 gigabits per second or faster through a copper wire, the electrons experience massive resistance.
And heat.
A ton of heat. And the power required just to move the data off the chip starts to rival the power used for the actual computing. It's a massive bottleneck.
So POAT's proposed solution is the electrical optical interposer, or EOI. Instead of pushing electrons through copper, they integrate lasers directly alongside the silicon to move data using light.
Which drastically reduces heat and latency while exponentially increasing bandwidth.
Right.
Which brings us back to that $2.4 billion market cap and that $53,000 quarterly revenue figure I mentioned at the start.
The Pizza Hut comparison.
Yeah. Here's where it gets really interesting. The financials are wild. They posted a $12.3 million net loss for the quarter. But here's the detail that really highlights the startup nature of this public company. Their stock-based compensation was $3.4 million.
Wow.
They are paying their specialized photonics engineers roughly 6.8 times their entire quarterly revenue, purely in stock.
Right.
And despite these fundamentals, they just closed a $400 million registered direct offering. A single institutional investor bought in at $21 a share, which is a premium over the $20.57 market, close plus warrants at $26.15.
Leaving them with a staggering $830 million in cash.
How on earth does a company with 53 grand in quarterly sales raise $400 million at a premium?
If we connect this to the bigger picture, this is the ultimate example of the valuation paradox.
Okay, explain that.
When an institutional investor writes a $400 million check at a premium for a company with negligible sales, they are not pricing the current balance sheet. They are pricing the severity of the bottleneck I just described. If POAT's optical interposer becomes the industry standard for bridging the GPU interconnect gap, the recurring licensing revenue will be astronomical.
And there are tangible catalysts driving that institutional belief, to be fair. Our sources highlight a $50 million initial purchase order from an AI hardware startup called Lumilens,
which has a framework that could scale to $500 million over 5 years.
Right. Furthermore, POAT isn't just selling white papers anymore. They physically demonstrated their Blazar hybrid laser at the recent Optical Fiber Communication Conference.
CREOSI conference, yeah.
So the technology is moving out of the lab.
The capital raise is effectively subsidizing the final mile of commercialization. The investors are trading $400 million today for early access to the potential profits of solving the primary hardware constraint of the entire AI industry.
But because POAT's entire valuation hinges on that future inflection point, the stock has become an absolute battleground.
Oh, a total war zone.
It's between short sellers who are convinced the technology will never scale and retail investors who see it as the next generational hardware leap. And I want to check in with you listening and be incredibly clear right now. Our goal in this deep dive is not to take a side.
No, not at all.
We aren't here to validate the short thesis or the retail bull case. Our goal is to dissect the mechanics of how these two forces interact. When the financials are this polarized, how do we separate the noise from the signal?
Well, this raises an important question because the tension itself is the signal.
What do you mean?
We have extreme short interest here. POAT's short float sits at over 16%, and IREN's is even higher at 18%.
Wow.
That level of institutional skepticism is colliding head-on with massive, unwavering retail momentum. Remember that tweet from the sources?
Wow, yeah, the one that said both POAT and IREN won the Fake It Until You Make It award?
Exactly. Continuously diluting retail to hoard cash, which then sets a baseline market cap. Let's unpack the short case first. Spearheaded by Wolfpack Research.
Right. They explicitly called POAT a classic stock promote. They argue the company has pivoted its business model 7 different times over the last decade without ever achieving commercial success.
And they pointed out the revenue is, quote, less than a grimy Pizza Hut.
There it is.
And they heavily emphasized the 303% increase in shares outstanding, plus the severe PFIC tax risks for U.S. investors.
Right. The PFIC designation is a crucial mechanical detail. It stands for Passive Foreign Investment Company.
Yeah.
Under U.S. tax law, if a foreign-based company holds too much cash relative to its active operating income, meaning it looks more like a passive bank account than a functioning business, the IRS can hit U.S. shareholders with highly punitive tax rates on their holdings.
It's designed to prevent tax evasion.
Right, but for a pre-revenue Canadian tech firm hoarding $830 million in cash, it becomes a massive liability.
But the retail defense, which is super active on platforms like Reddit and StockTwits, they actively attack the Wolfpack thesis.
They dismiss it entirely.
They point to the verifiable Blazar demo and the Lumilens deal as proof the tech is real. And more importantly, they highlight that POET is explicitly re-domiciling to the United States.
Which directly eliminates the PFIC tax issue.
Exactly. But it does something else too. Redomiciling makes them eligible for major U.S. defense funding, specifically a DARPA program called Picasso.
Right, Picasso. Photonics in the package for extreme scalability.
Yeah, it's a matter of geopolitical strategy. The U.S. government recognizes that whoever controls the optical interconnect supply chain controls the future of AI scaling. By moving to the U.S., POET positions itself for non-dilutive government grants aimed at securing domestic photonics dominance.
And layered over all of this strategic maneuvering is raw corporate drama. The Reddit forums are obsessed with POET CFO Thomas Mika.
Oh, the StockTwits interview?
Yeah. He reportedly went on a StockTwits interview and inadvertently broke a non-disclosure agreement. He allegedly named Marvell, who had just acquired another photonics player, Celestial AI, as a partner.
And according to the rumors driving the stock volatility, that leak caused Marvell to instantly cancel their purchase orders.
And now, Mika is retiring. So when you have technical breakthroughs, punitive tax traps, DARPA funding, and CFO drama all swirling around a $53,000 revenue stream, how does the market even begin to price this rationally?
It prices it through the exact mechanism we discussed in the 2019 academic paper, cash hoarding. The $830 million war chest is POET's ultimate defense mechanism against the short sellers.
Because you cannot force a company into bankruptcy when they have nearly $1 billion in the bank.
Precisely. They have bought the most valuable commodity in deep tech, runway.
Right. They've effectively immunized themselves against near-term failure.
The continuous capital raises, the premium direct offerings, they have built a financial fortress around their R&D department. The short sellers are betting the underlying physics of the technology will fail before the cash runs out.
While the retail bulls are betting the cash will last just long enough for the optical interposer to become the indispensable standard for every AI server rack on the planet. It's a high-stakes waiting game played with billions of dollars. And we've covered a massive amount of ground today.
We really have.
We started with the foundational mechanics of at-the-market offerings, exploring how companies quietly dribble out shares to bypass traditional investment banks.
Right.
We watched IREN utilize complex convertible notes and capped calls to pull forward $9.2 billion, arbitraging their crypto energy assets to buy the physical GPUs required for AI clouds.
And we broke down POET Technologies, a company leveraging the severe physical limitations of copper interconnects to secure an $830 million safety net.
Creating a massive standoff between institutional short sellers and retail true believers.
Yeah.
So, why does this matter for you listening? Because being well-informed about modern tech valuations requires looking past the product announcements. You have to examine the capital structure.
You have to understand the mechanisms of the funding.
Exactly. A revolutionary microchip or a new photonics laser doesn't matter if the company can't engineer the financial runway to survive the development cycle.
Which leaves us with a broader, somewhat provocative question to consider.
Let's hear.
If the dominant model for technological innovation now requires raising billions from retail investors and direct offerings long before the product is fully commercialized, has the public stock market fundamentally changed?
That's a good point.
Is it now essentially functioning as the new venture capital landscape? And if so, are everyday investors being given unprecedented ground floor access to the infrastructure of tomorrow? Or are they simply subsidizing the massive R&D risks that traditional banks refuse to touch?
Man, it really forces you to look at every high-growth tech stock in a completely different light. They aren't just selling you a piece of the future. They are asking you to finance the construction of it, one dribbled-out share at a time. Thanks for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we'll see you next time.